everybody, Joseph Gozlan with Eureka Business Group, and today it's part 3 of our series about multifamily financing. Today's focus is going to be on bridge loan and Cmbs loans. These are two very important types of loans in the commercial real estate world, and specifically in the multifamily. So we'll start with bridge loans. The type of loan for bridge is just like its name. It's to bridge between the acquisition and the permanent financing. Sometimes you need it because the property needs a lot of work and needs rehab, and it just wouldn't qualify for an agency debt like we talked about in the previous part of the series. If you haven't seen it already, just look at the links below. We will have a link to all the different parts of the series. So bridge loans usually are larger in terms when you go into the lower volumes like the $500,000 and $1 million. There's really no real value in taking a bridge loan over a small bank loan, but they're existing. They will help you get through financing properties that would usually will not finance otherwise. So that's what bridge loans are mostly for, that period between when you buy the property and the property qualifies and you're ready to put a permanent financing on it, whether it's bank loans or Cmbs loans or agency debt. It doesn't matter what the permanent financing is going to be. Usually they are short term, anywhere between 6 months and 3 years, give or take. They're usually an option to extend. Sometimes it's hard by the 12 or 24 months deadline, but really it's short term, it's temporary. A lot of them will do interest only for the entire duration, so you could take a 24 months interest only bridge loan. The interest rates are going to be somewhat competitive in this market with the Cmbs loans and the agency debt. They're going to be, we're recording this in late 2019, so usually it's around the 5 to 6% rate, sometimes less, sometimes more. The smaller the loan, the higher the interest rate. Smaller the lender, the higher the interest rate. They're equivalent in the residential world. If you know, residential flipping would be hard money loans, right? But hard money loans are usually higher interest rate and a lot more predatory, versus bridge loans in the multifamily world are designed for better terms and understanding the business. They're underwriting the property right along with you. They will lend you anywhere between 60, 70, 80% LTC, loan to cost, how much you paid for the property, plus anywhere from 75 to 100% of your rehab budget. So let's say you buy a property for $4 million and you need another $1 million for rehab. They will lend you 75% or 80% from the $4 million plus either $800,000 all the way up to the entire $1 million you need for your capital expenditure. Bridge lenders are usually full recourse all the way up to $4 or $5 million loan amount. Anything over that opens up the opportunity to be non-recourse. So the higher the loan amount, the more flexible they are, and the more understanding that this is a business and not a personal loan. Just to recap, bridge loans, usually you take them when the property cannot qualify for a permanent loan, or when there is a lot of value add or rehab that needs to be done. This is a strategy a lot of investors are using these days because the projects are all about finding a property that is distressed, finding a property that is not performing well, doing a value add, and then 2-3 years later refinance and get more of your money, investors' money out as soon as possible. So a bridge loan is a perfect opportunity. One last situation where I've seen people use bridge loans is bridge to HUD. So HUD loans, we talked about that in the agency debt part of the series, is the holy grail, right? It's 35 years, fully amortized kind of loan at a very low interest rate. So everybody wants it, but nobody can have a seller that is willing to wait 8, 9, 10 months until that loan process is going through. So a lot of the HUD lenders have built an in-house product that allows them to do a bridge to HUD. So they will underwrite you for the HUD loan up front when you buy the property, and then they're going to say, okay, let's buy it. We'll put a bridge loan on it with 12 months interest only, and then we'll convert you into a permanent HUD loan 8, 9, 10 months into it once we're done with the process of going through all the HUD loan procedures and inspections and so on. So that's a lot of the opportunities. I've seen a lot of multifamily investors use bridge loans these days. Another type of loan we're going to talk about today is CMBS. CMBS loans, the acronym stands for Commercial Mortgage-Backed Securities, which means your loan is being wrapped, then sold off to an investor. This way the bank that gave the loan, that facilitated the CMBS loan, doesn't have that on their books. It's keeping their liquidity position open. So they like to do these things. The CMBS loans are very similar to agency debts. There's a few minor things you have to consider. One is the amortization rate. Sometimes you can get a CMBS loans go all the way up to 30-year amortization like an agency debt would, but a lot of the time we see 25, 20 years amortization, which obviously is not as good as the agency debt. Interest rates are very competitive these days. They're not as good as the agency debt these days, but they're going to be better than the local bank loans, for example. One huge advantage that CMBS loans has over the local bank loans, just like the agency debt, is that it's non-recourse. So you get a loan, it's a commercial loan, it's non-recourse, doesn't go back on your personal debt to income ratio and so on. So that's another great advantage. We're also seeing, in terms of how long they'll give you the loan, it's usually going to be anywhere 5, 7, 10 years. Very rare occasion you'll see 15, but for the most part they're about the 5 to 7 year term. And then at the end of that term you have a balloon. Basically you get to your 5 or 7 year point and then you're going to have to refinance. In terms of prepayment penalties, the CMBS loans follow pretty much same guidelines as agency debt. You're either going to have a deficiencies or you're going to have a yield maintenance clause in your loan docs that basically costs a lot of money to get out of it, and it's gradually going down as you progress in the lifetime of the loan. CMBS loans have been very popular before Fannie Mae, Freddie Mac kind of exploded in the multifamily world. They're still extremely popular in the retail and office and all the other commercial assets type, but today they're finding really hard time competing with the agency debt. If you can get an agency debt, it's probably a superior loan to the CMBS. But that leads me to one of the biggest advantages of CMBS loans is that their underwriting criteria is a little bit looser than the agency debt, which means there will be a lot of properties where you could not finance those through Fannie or Freddie, but you could finance them with a CMBS loan. So that's really the greatest advantage of CMBS loans in this market today. I hope this video was helpful. Like I said, it's a 4-part series of multifamily financing. Part 1 was about local bank loans and small credit unions and so on. The second part of our series was about multifamily financing through agency debt, Fannie, Freddie, and Ginnie Mae. And then this part, like we talked about, is about bridge loans and CMBS loans, and part number 4 is coming up soon with other kinds of loans. My name is Gozlan. I'm with Eureka Business Group. Our website is ebgtexas.com. If you have any questions or if you have any ideas of other material you want us to cover in our videos, please leave a note in the messages below and we'll be happy to do that. Thank you.